This is Chuck Oliver. Welcome to this week's Taxes Save Case of the Week. Super excited with the big topic on Roth conversions, the myth conceptions, as we sometimes call them, that if somebody's a high income earner, they should not be looking to Roth convert. Those are precisely those of you listening that are higher income earners and or heavy savers. You are absolutely who should be Roth converting now if you have the strategies with proven results, right, that allow big deductions to not recognize reporting more taxable income because of using deductions to offset the conversions. We're about to go into a case. I'm excited to turn over to Davis that's going to walk you through somebody that has a lifetime tax savings to her husband, and their four daughters of over $4 million by taking the proper approach and steps necessary to strategically save tax, and you can too. So, Davis, let's get into it.
Yeah, like you said, Dad, this is a really long-term plan that's really exciting that we're about to get into. So go ahead and share my screen, and hopefully you guys are seeing everything over here today. So you'll see here on the left, we got the tax return. On the right, we have kind of breaking down this client situation. So these are two high income earners. They're doctors out of the state of Texas. So no state taxes here, as you know, just federal tax burden we're fighting up against. So the ROI is not as strong as normal, but still a great one nonetheless. And so here you can see, right, on the left, we have their income, right? On 1Z, this is their W-2 income, almost 1.8 million. Some interest in dividend income, but the big one here is they converted almost 2.685 million dollars from IRA to Roth, right? They have about 5 million they've amassed through the years. And these clients are closer to RMDs than some of our other ones we work with. These clients are in their early 70s, coming up on the next year of their first RMD. So it's vital to get this planning going to get out of this RMD, or at least lessen it to a good degree. So you'll see that here, what was taxable of that was almost $2.5 million, right? So they have high income and they have a lot to Roth convert. So does it still make sense? We get that question all the time, as you know, Dad. So breaking down this client situation, you'll see here, right? They have about 4.34 million of income all added up, high income. And their tax burden is about 1.52 million federally in the state of Texas. All right, so we're looking at that 35% effective tax rate. So what do we do? We went to one of our tried and true strategies we use, our client families get to use, and that's Section 181. Right? It's a phenomenal strategy. It's a great strategy that offers a 4.25 to 1 tax deduction. So what this client did, they outlaid in two movies, 200,000 to generate $851,000 of deduction. Right. And so here with we working with our tax team, of course, there's some things we run into. So this is really a 2-year plan. We used a big chunk of that deduction for 610,000 in the first year, right? And you'll see that here on line 8 as we scroll down here. Right. So line 8 is what we're looking at here. And that's where about 607, all 610 was used, but showing 607 from that K1 after outside of their other K1 income being offset. So here we were able to carry forward of that 851,000, $241,000 of deduction to the next year. So we have a 2-year ROI of overall tax savings this client achieved. So what did we happen after the first year, right? We went from 4.3 million down to almost 3.7 million. Tax burden dropped from 1.5 million to 1.283. And we dropped not as huge as we've seen in other scenarios, again, because we're still in such a high bracket, but we really got them out of that 30% effective rate, just beneath 35% effective rate, just beneath 30%. So 29.6% effective rate. So right there, their tax savings in the first year, again, they outlaid 200,000 to get back in first year $237,651 of tax savings. So about 118, 119% ROI with that 5.4% effective tax rate. But the next year, right, what we're doing in the second year for this client, they carried forward 241,000. Remember, they have $5 million. We're going to need more planning, and we are working on planning with this client. And that's where we have another tax savings, just with that deduction alone, finishing that out, about 95 grand of tax savings. So all in all, between 2 years of planning, 160% ROI, return on tax savings, they achieved there, right? Between year one, the investment in one we captured the investment back and then some, but year two is really where we got the remaining crux of this tax savings for the first year. But hey, I want to point out here, as you know, Dad, and it's exciting one, as you said at the beginning, we didn't do it really for the first and second year tax savings. That's one reason, we got underneath our belt here. But the biggest reason is I'll bring up here, right, is the long-term tax savings. Remember, this client is 69 and 70, so they're facing some of their first RMDs in the coming years. So this planning is much more key for them in outrunning these RMDs. But yeah, I'll pass back to you, Dad, to kind of introduce what we're going to get into
Yeah.
next.
Well, and that's the thing I think, it depends on what lens you're looking through, right? Are you looking through kind of today's short-term lens or the long-term lens? These clients clearly have more than enough income that supports their lifestyle if you were to know them. Their big concern was leaving a massive tax liability to their four daughters.
Yeah.
And this was a way to start chipping away at that. And there's other strategies and things, as you can imagine, that we're already obviously working with, as we do many people, right? Sometimes it's a combination of strategies that ends up, developing and accomplishing the greatest long-term tax savings as well as short-term. In this particular case, let's go ahead and transition, Davis, and kind of share what that long-term tax savings is, because by just knocking out this 850 some thousand dollars, we'll call it 850,000 alone. If you want to kind of walk them through like what the overall plan accomplishes, right? Because it's going to take their five wherever they were all the way down, and then let's look at what the significance of the long-term lifetime tax savings is going to be by just chipping away at it these last couple years.
Yeah. No, great point. So you can see here they're starting off this last year before the conversion was done, pre-Roth conversion of that about 2.7 million they converted, and about 5 million bucks. I mean, a sizable amount of savings, right? And so again, this being the big tax picture they have of legacy risk, they're age 69, right? 5 million of tax deferred, and that money's growing at about 8% growth rate. They have some great alternatives. They're doing well, a lot of different things that are putting up the portfolio. But here we're just going to show a meager 8%. And then we give their tax liability, right? And that 37%, 35% effective. And so here, right, what are they facing of tax risk on this money, right? To them, just on RMDs of 5 million, they're going to pay $3.4 million of RMD taxes alone. And that's just from age 73 to age 90. So 17 years, 3.4 million of taxes. Pretty hard to believe. Then the cardinal sin we see is, Dad, they reinvest those tax savings in a brokerage account just to get hit again with interest and dividend tax. And then the big one for them, the one they're out trying to run, the worst of them all, is this 3.89 million of legacy tax, just assuming they pass at 90. All combined on 5 million today, they do nothing. That's why we did something. They're looking at $8,791,000 of tax for them and their legacy if they don't do anything. So after converting, again, to remind you, after converting almost $2.7 million, 2,685,000, it brought them down to this $2,314,000 amount. Same variables, but let's look at the reduced in risk, right? This is where over $4 million was saved. Because again, we're going from 8.791 million. With that Roth conversion, it reduced that tax risk to $4 million. It's a $4 million long-term tax savings that them and their family will achieve by actually putting a plan together and getting a Roth conversion plan where they didn't have otherwise. The first year ROI savings might not have been as great, but the long-term ROI is that much greater. And that's the true reason of why we did this.
Well, and you can find all of these case studies and the ability to request your own tax risk analysis, which we call a saving tax optimization plan analysis at taxessaved.com. That's taxessaved.com. And the thing to leave you with as we go is keep in mind, it doesn't matter how old, it doesn't matter how young. If anything, the great wealth transfer is projected to be 124 trillion over the next 20 years. Of that, only 21 trillion is trapped in these IRA 401ks. So whether you have a business that you're selling, whether you have a portfolio, right, where the other administration was trying to treat gains over $1 million as ordinary income, the time to address taxes is now. That's why I have so many people now referring their adult children to prevent this. And then we have a lot of adult children trying to get their parents to prevent them leaving them these large, massive, tax bust, back breaking, tax liability of inherited IRAs. So Go to taxesave.com. It's simple. You're going to see as you open it, we have an on-demand webinar that you can watch on your time. Start it, stop it. You just click the red, square with the white arrow and click it. Put in some like 2 seconds to put in some quick information, and then you can watch it on demand. And then scroll midway down the page, and you'll see in the upper right-hand corner 3 lines that by clicking that, it'll take you into the library of the taxesaved.com episodes or library case studies, if you will. And then you can see if you're a self-employed, you can look at the business owner case studies. If you're W-2, if you're looking to do Roth conversion, if you're trying to protect legacy. But folks, the uncertainty of what's going to happen, whether the big beautiful bill goes through, how much of it's temporary through 2028, how much of it might only be right, may not go through, how much of it may be permanent. Don't defer tax. Deferring tax is increasing your taxes. So the longer you wait, depending on what you've saved, we see sometimes it's costing clients hundreds of thousands of dollars a year by waiting. Taxessaved.com, taxessaved.com.